morning, everyone. So today we will be discussing contemporary issues in monetary policy, focusing on how central bank and monetary policy respond to economic instability, financial crisis, inflation, and changing financial system. So monetary policy plays a critical role in maintaining economic stability by influencing money supply, interest rate, employment, investment, and inflation. So however, in recent years, policymakers have faced increasingly complex challenges due to global financial crisis, pandemic, and economic uncertainty. In this panel discussion, we will explore four important areas. First, we will discuss the effectiveness of unconventional monetary policy after the global financial crisis. Second, we will examine how monetary policy is used during financial crisis to stabilize economies. Third, we will analyze the monetary transmission mechanism and its influence on macroeconomic stability. Finally, we will discuss the major challenges and constraints faced by monetary policy makers today. So each panelist will present their analysis supported by real-world example, theoretical concepts, and policy evidence. We hope this discussion provides a deeper understanding of how modern monetary system operates and how central banks manage economic uncertainty. First, let me begin by introducing our four panelists here today. So we have Karma Zangma as central banker. She will explain how unconventional monetary policy measures introduced after the global financial crisis and evaluate whether these policies were truly effective in restoring economic stability. Second, we have Srinyanti as monetary economist. She will discuss how central banks manage crisis and maintain financial stability during periods of severe economic disruption. Third, we have Rindu as financial market analyst. She will discuss how monetary policy decisions influence investment, inflation, exchange rate, and overall macroeconomic stability. And lastly, not the least, we have Kelvin Jordan as policy critic. She will discuss the major challenges confronting monetary authorities in today's increasingly interconnected global economy. So let us officially begin this panel discussion. To begin with this discussion, we have Karma Zangma, so you can now begin with your points.
Thank you, moderator, for giving me this wonderful opportunity. So, the global financial crisis of 2008 was one of the most severe economic conditions since the Great Depressions. Many central bank collapsed and the unemployment increased rapidly, and the financial market also lost public confidence, and the traditional monetary policy such as interest rate became inefficient because the many countries has already reduced the interest rate. It goes to zero, and as a result, the central bank introduced unconventional monetary policy measures to stabilize the financial systems and encourage the economic recovery. And one of the most important unconventional monetary policy is the quantitative easing. So under that, under quantitative easing, the central bank purchased a large quantity of the government bonds and a financial assets from the commercial bank and the financial institutions, and this increased the liquidity and also encouraged the bank to continue lending to business and households. And the Federal Reserve System introduced a several round of the quantitative easing after the 2008 crisis. And similarly, the European Central Bank and the Bank of Japan also implemented this similar program to support the economic activity. And then another important policy was forward guidance. So this involves central bank communicating future policy to influence the public expectations. So by assuring the market that the interest rate would remain low for extended period, the central bank encouraged borrowing, investment, and consumer spending. So this helped improve confidence during the period of the uncertainty. And some country also introduced negative interest rates. So the central bank were charged for holding excessive reserve with central bank, to encourage them to lend more money into the economy. So the liquidity facility were also introduced to provide emergency support to financial institutions facing the short-term cash shortage. This policy introduced a several positive outcome. Financial markets stabilized, unemployment gradually declined, and the economic growth resumed in many countries. And the banking system recovered, and the confidence returned to the investors and consumers. And during the COVID-19 pandemic, the central bank again used many of these unconventional tools successfully to prevent another severe financial collapse. And however, the unconventional monetary policy also faces criticisms. So one major criticism is that the quantitative easing increased the wealth inequality because rising stock and the property price mainly benefit the wealthy individuals who own the financial asset. And then another criticism is that the excessive money supply may create a long-term inflationary pressures. So some economists also argue that the prolonged dependency on the central bank support may create financial bubbles and reduce the market discipline. Despite this concern, many economics believe the unconventional monetary policy tools were necessary because the traditional tools alone could not address the severities of the crisis. So without this intervention, the recession could have become far worse, leading to higher unemployment, business failures, and deeper financial instability. Thank you.
So thank you for giving us such an insightful information. So based on what you have said, I would like to ask you one question. So some economists argue that quantitative easings only created artificial economics recovery by inflating asset prices rather than improving real economic productivity. So to what extent do you agree with this criticism?
Thank you for the question. So I personally agree with criticism because quantitative easing did increase the asset price significantly, especially in the stock and house price, while the individuals who own the assets benefits more than the lower income group. However, it is also important to recognize that during a severe financial crisis, restoring the confidence and the liquidity is immediate priorities. So the quantitative easing did prevent the financial market from collapsing entirely and support the lending, unemployment, and investment. Therefore, while it may have created some inequalities and financial distortions, it still played an essential role in stabilizing the economy during the emergency. Thank you.
Thank you for explaining both the benefits and criticisms of unconventional monetary policies. So while these tools were designed to restore economic confidence, monetary policy also plays a major role during financial crisis themselves. So let us jump to our next panelist, Shriyanki. So she will now discuss how central bank manage crisis and maintain financial stability during periods of severe economic disruption. So you can now start with your.
Thank you, Rosita. I, as the monetary economist of this panelist, I will discuss the theoretical rules of monetary policy during the financial crisis and how central bank respond to maintain the economic stability. Important theory is Keynes theory, which explains that during the economic downturn, consumer spending, business investment decline, leading to unemployment and slow economic growth. To respond to this situation, central bank reduced interest rate, encouraged borrowing, spending, and investment. However, during 2008 global financial crisis, traditional monetary policy became less effective because banks and consumers lost confidence in the financial system. This situation created a liquidity trap where people prefer holding cash instead of lending or spending money. At the same time, central bank act as a lender of last resort, providing emergency liquidity to support financial institutions, which was important because the banking system operates under financial restricted banking, where banks keep only a small amount of reserve and lend the rest. Without a central bank, many banks would have failed during the crisis. Central banks such as Federal Reserve System also use quantitative easing to inject liquidity into the economic and restore confidence in the financial institution. Similarly, during COVID-19 pandemic, central bank reduced interest rate to provide emergency support to the business and financial institution to support economic stability. However, this intervention also creates concern about moral hazard. If the bank believes that there will always be a rescue during the crisis, they may take excessive risks in the future. Therefore, the monetary policy intervention is necessary during the several crises. Policymakers must ensure proper financial regulation and long-term financial stability. In conclusion, monetary policy play a crucial role in maintaining a financial stability and restoring a confident and stable economic during the financial uncertainty.
Thank you for your detailed analysis on financial crisis management. So your explanation of the lenders of last resort function and the role of central bank during the 2008 crisis and COVID-19 pandemic demonstrated how essential monetary policy intervention can be during periods of economic instability. You also raised important concerns on regarding moral hazard and financial discipline. So to ask you one question, do you think the repeated central bank intervention during crisis weaken free market discipline and encouraging irresponsible financial behavior among banks and investors?
Yes, repeated intervention can lead to moral hazard because financial institutions may expect the central bank to support them during the crisis and may take several risks again. However, central bank intervention is still necessary because allowing the financial system to collapse would seriously harm the economic, business, and the citizen. Thank you.
Thank you for highlighting the balance between financial stability and market discipline. So monetary policy does not influence bank during crisis. It also affects the wider economy through several transmission channels. So moving on to our next panelist, we have Rinzel Lomo, a financial market analyst. So she will now explain how monetary transmission mechanism and its impact on macroeconomic stability. So you can now begin with 4 points.
The monetary policy transmission mechanism is the process through which monetary policy decisions affect the economy. When central banks change interest rates and money supply, these changes influence borrowing, investment, spending, inflation, employment, and the economic growth. Understanding this mechanism is very important because it explains how monetary policy achieves macroeconomic objectives. The first and most direct channel is the interest rate channel. When central banks reduce interest rate, borrowing becomes cheaper for businesses and consumers. Lower borrowing cost encourages investment in business and the consumption. This increases aggregate demand and stimulates the economic growth. On the other hand, interest rate reduces the borrowing and spending, helping to control the inflation. Another important channel is the credit channel. Monetary policy affects bankers' ability and willingness to provide loans. During expansion in monetary policy, banks have more liquidity and increased lending to business and households. Increased access to credit supports economic activities and job creation. The exchange rate channel is also highly significant in open economics. Lower interest rate often reduces the value of a country's currency because investors seek higher returns elsewhere. A weaker currency makes exports cheaper and imports more expensive, improving trade competitiveness and increasing demand for domestic products. The asset price channel affects stock markets, property value, the household wealth. Expansion in monetary policy increases stock prices and real estate values. As household wealth rises, consumers feel more financially secure and increase spending, further stimulating the economic growth. Expectations also play a major role in the transmission mechanism. If businesses and consumers trust central bank policies, they are more likely to spend and invest confidently. This is why policy credibility and effective communications are essential for successful monetary policy. However, the transmission mechanism does not always function perfectly. During financial crisis or liquidity traps, banks may refuse to lend despite lower interest rate, and consumers may also reduce spending due to the uncertainty. This weakens the effectiveness of monetary policy. Therefore, economic conditions and public confidence is greatly influence how monetary policy affects the economy.
Thank you for clearly explaining the different channels through which monetary policy affects the economy. So your discussion on interest rate, credit, exchange rates, asset price, and expectation helped us better understand how central bank decisions influence economic growth, inflation, and investment behavior. So same as the other two panelists, I would like to ask you one question. So which transmission channel became least effective during severe economic recession and why?
During severe recessions, the credit channel become less effective because banks may become unwilling to lend despite increased liquidity and the interest rates. Business and consumers may also avoid borrowing due to the uncertainty about the future economic conditions. These situations weakens the ability of monetary policy to stimulate investment and spending. So in such cases, central banks may need to use unconventional monetary policy tools to coordinate with fiscal policy to support the economic recovery. Thank you.
Thank you for explaining how monetary policy decisions influence different sectors of the economy. So although monetary policy remains a powerful economic tool, policymakers continue to face many difficult constraints and trade-offs. So now moving on to our last panelist, we have Kazan Choden. She will discuss the major challenges and constraints facing modern monetary authorities. So you can now begin with your points.
Firstly, thank you, moderator, for this opportunity. Modern monetary policy makers face many challenges in balancing economic stability, inflation control, employment, and growth. One of the biggest challenges is trade-off between controlling inflation and maintaining economic growth. When inflation rises, central bank often increase interest rate to reduce spending and borrowing. However, higher interest rate can slow business investment, increase unemployment, and weaken economic growth. These challenges became clear after COVID-19 pandemic, when countries experienced high inflation due to supply chain disruption and increased government spending. Central bank raised interest rate aggressively to control inflation, but this also created fear of recession and unemployment. Another challenge is maintaining policy credibility and central bank independence. Central banks are expected to make objective decisions without political interference, but government may pressure them to keep interest rate low for short-term economic or political benefits. Excessive political influence can reduce public confidence and weaken monetary policy effectiveness. Liquidity traps are also a major limitation. When interest rates are already very low, consumers and business may still avoid spending and investing because of economic uncertainty. In such cases, traditional monetary policy became less effective, forcing central bank to use unconventional measures like quantitative easing. Global financial spillover further complicate monetary policy. In an interconnected world, policy decisions in major economies can strongly affect developing countries. For example, when Federal Reserve raises interest rates, investors may move capital from smaller economies to United States, weakening currency and creating financial instability. In addition, rapid technological change and digital financial system create new uncertainties. While financial technology improves efficiency and innovation, it also makes it harder for central bank to control money supply and financial regulation. Overall, monetary policy makers must constantly adapt to changing economic conditions while balancing multiple objectives, making modern monetary policy increasingly complex.
Thank you for a thoughtful discussion on the challenges facing monetary policymakers today. So your analysis highlighted the complexity of balancing inflation control, economic growth, central bank credibility, and global financial pressure. You also emphasized how globalization and economic uncertainty continue to complicate modern monetary policy decisions. So now moving on to the question and answer session. So my question for you is, should the central bank prioritize inflation control even if it leads to slower economic growth and higher unemployment in the short term?
Firstly, thank you for the question. In most cases, controlling inflation should remain a priority because extremely high inflation can damage purchasing power, reduce saving, increase uncertainty, and destabilize the economy in the long run. However, central bank must also consider the social consequences of aggressive monetary tightening, such as unemployment and reduced investment. Therefore, policymakers should aim for balance and gradual policy adjustment rather than focusing on inflation without considering broader economic impacts.
Thank you. So, thank you everyone for the informative presentations. So throughout this discussion, we have explored how monetary policy affects economic recovery, financial stability, inflation, and global market, However, many of these issues remains highly debated among economists and policymakers. So therefore, we will now move into an interactive discussion session to critically examine some of these debates and allow our panelists to engage with one another's viewpoint. So in this session, any one of you can participate. So we will move into it. To begin with this session, my first question is, do you believe unconventional monetary policy has become a permanent feature of modern central banking rather than simply an emergency measure? So any one of you can answer this, or you can discuss within yourself.
Let me answer your questions. Yes, to some extent, unconventional monetary policy too has become more normalized because recent crisis shows that traditional tools alone may not be sufficient during the economic disruptions. However, over-reliance on these policies could create long-term risks such as asset bubbles, excessive debt accumulation, and inflationary pressures.
And thank you for that. Now let's move on to the next question. So how does globalization reduces the effectiveness of domestic monetary policy in smaller economies?
To answer your question, so the globalization increases the economic interdependence, meaning the domestic economy are heavily influenced by the external events and policy from the larger economy, and the exchange rate volatility, international capital flows, and imported inflation may reduce the ability of the smaller central bank to fully control the domestic economic conditions independently. Thank you.
Thank you. So now moving on to the last question. So can monetary policy effectively solve supply-side inflation caused by external shocks such as war or pandemic?
So to answer that question, monetary policy has limited effectiveness against supply-side inflation because raising interest rates cannot directly solve shortage in energy, food, and supply chain. However, central bank may still tighten policy to prevent inflation expectation from becoming permanently high and destabilizing the economic further.
Thank you for that answer. So to summarize, so today's panel discussion highlighted the growing complexity of modern monetary policy and the important role central bank plays in maintaining economic stability. So we discussed how unconventional monetary policy supported recovery after financial crisis, how monetary authorities intervene during emergencies, how monetary policy is transmitted throughout the economy and the major constraints faced by policymakers today. Our discussion also demonstrated that while monetary policy remains a powerful economic tool, it is not without limitation. Financial globalization, political pressure, inflationary challenges, and economic uncertainty continue to test the effectiveness of central bank strategies. Therefore, successful monetary policy requires a careful balancing of economic objective, strong institutional credibility, and international cooperation. So thank you everyone for listening to our panel discussion. We hope this discussion provides valuable insight into the evolving role of monetary policy into the modern global economy.